Hello and welcome to Portfolio Matters Week 90 weekly update. And it's been a very dramatic week in the UK. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Well, it's been a very busy week in UK politics, as I'm sure you're all aware. So, on Monday, the new Chancellor, Jeremy Hunt, essentially reversed the vast majority of Liz Truss's tax cuts, and that reassured the markets and led to a rally in both gilts and sterling. On Wednesday, we had chaotic scenes in Westminster over the fracking debate. The chief whip and the deputy chief whip resigned and then unresigned. And then on Thursday, everyone resigned. The Home Secretary resigned, then Liz Truss resigned, leaving the UK essentially to find a new Prime Minister. Chaos reigns in Clown Town. Now, the Bank of England, because of the shenanigans in the gilts market, suspended QT, but it's now saying that it intends to commence QT on the 1st of November with sales of short-term gilts. Now, every time it's tried this in the past, it's essentially had to stop QT almost immediately when it begins. So we will see whether it manages to shrink its balance sheet. Germany has seen sense and is prolonging the life of its 3 remaining nuclear reactors throughout the winter, but they are saying they still intend to close them in April. China, this is interesting, has indefinitely delayed the publication of its GDP statistics while it makes them up. And most importantly for markets, the global bond sell-off continues, and we will go into that. So it's been total chaos in the UK. And the Daily Star had a competition to see who would last longer, a lettuce or Liz Truss. The lettuce won, although the lettuce ain't looking too good. And we now have to find a new leader. So chaos is not over yet. And if there was going to be an election tomorrow, it would be a Labour landslide. Now, I think one of the causes of the political chaos in the UK was the Tory government's overconfidence because of its big majority. And I worry that next time, if Labour gets in, they'll have an even bigger majority. So what good governance generally comes from the party feeling it needs to be sensible. Otherwise, it will lose a vote. And if a party has a huge majority, it doesn't need to worry about that and can do silly stuff, as we've seen from the Truss government. Now, this is a breakdown of the change in the UK fiscal deficit after all the changes of the last month. So you see that beginning of the year in March, the OBR was forecasting that the fiscal deficit for 25-26 would be 35 billion. We then had the mini budget, which is actually 39 billion, but also we've had extra debt interest because of the rise in gilts, leading to a forecast after all that the deficit would be 134 billion. Now, Jeremy Hunt has scrapped some of the tax raises and the cut in income tax, but that still leaves him to find a further 40 billion of savings in order to get to fiscal sustainability. So the bottom line is he needs to either cut spending more or raise taxes further. So the fiscal crisis in the UK is not over yet. Okay, moving on to economic data. So we had actually quite a small data update this week, so I'm going to go through it all. So we had the University of Michigan consumer surveys in the US this week, and they all beat expectations. So consumer sentiment actually rose from September to October. Reminder that 100 is neutral, so it's still rubbish. The current conditions index actually rose sharply. So in September, it was 59.7. It's expected to decline slightly to 59.2, and it rose to 65.3. So US consumers are actually feeling better about the world. And sadly, that also leads them to expect inflation to be more persistent. So in September, they're expecting US inflation of 4.7% over the coming year. They now expect 5.1%. And their 5-year inflation expectations also rose to 2.9%. And all of that means that the Fed is going to have to continue raising rates to bring inflation expectations back under control. We also had industrial production numbers in the US for September, and those beat expectations. The expectations were they would fall to 3.4%. They actually rose to 5.3%. So the US economy continues to show resilience. However, housing starts missed expectations, slowing more than expected, although the number of housing permits issued beat expectations, actually rose despite rising mortgage rates. Now, we also had two manufacturing indexes, one from the New York Fed, and that missed expectations by a decent margin. It's expected -1. The October number came in at -9.1, and the Philly Fed manufacturing index also missed expectations. Now, the only other data we have is UK inflation. UK inflation slightly beat expectations, coming in at 10.1 versus expected 9.9. The core came in at 6.5. Richard, some charts.
Thanks, Keith. UK CPI, really a very worrying chart there, not showing any signs of topping. And likewise, the core CPI, going to be a lot of wage pressure continuing. Consumer sentiment index, well, it's not good, is it? And as Keith says, it's 100 is neutral, and it's very definitely well below that. US Michigan current conditions index very low, at a bit of a tick up, but as low as it's been since 2000, almost as low as it's been since 2000 still.
What I find interesting about all these consumer surveys is how infrequently they go above 100. I mean, in the EU, it's almost never got above 100. Consumers always feel rubbish about the world.
Maybe they need to reset the level of 100, don't they?
Yeah.
1 year inflation expectations were sort of bumping around the 5% at the moment. We shall see. The 5-year inflation expectations look to me to be unrealistically low, frankly. And industrial production year on year is fairly stable, actually, last 12 months or so.
Yeah, absolutely. The US economy is showing surprising resilience.
Yeah. And the Empire State Manufacturing Index, which is actually not looking particularly healthy, it's on a spiky downward trend. And Philadelphia is sort of in a similar direction, similar way, very spiky data. The US housing starts, we think they will continue to fall and they have spiked up recently, but coming back down
Yeah.
now.
I mean, given the rising mortgage rates, you'd think it's absolutely inevitable that housing starts should fall. But the absolute level of these housing starts is quite impressive. They're
I
still
was
starting a lot of houses.
So I was reading the other day that basic housing stats is made up of two things: single family houses and multiple occupations flats. Effectively, there's a shortage of flats, and so one of the housing starts subsectors is not under so much pressure. The other one is under more pressure, and what this is a sort of blended figure.
Yeah.
US initial jobless claims there's definitely a bit of an upward trend there, but it's only just beginning to get itself going. And continuing jobless claims, I would say, there's not an upward trend in that yet.
Mm.
And 30-year mortgage rate, well, just continuing to climb very steeply.
Yeah. Now, remember, in the US, almost all US homeowners are on 30-year fixed, so they will be unaffected by this more than doubling of the 30-year mortgage rate over the last year. But that will really affect affordability for first-time buyers.
Yeah. And US house builder sentiment index is slumping. Now, this presumably will continue to feed through into new starts and permit applications.
Yes, and it's surprising it hasn't yet, really.
So, we're seeing a reasonably resilient consumer. Inflation expectations remain elevated, although I would say the 5-year is too low, personally. Manufacturing activity is slowly declining, and UK inflation is no longer transitory.
It was never transitory, as we talked about in the 2 years of this podcast. Okay, on to one chart. I think this is a very good chart of actually what happened in 1974, but also you can be read for what happens in essentially pretty much every bear market. And so the vertical gray line is the peak of Fed tightening. And the point of this chart is that the peak of Fed tightening does not mark the bottom of the bear market. There were lags involved in everything in the economy. And if we look at other bear markets in history, this table shows the depth of the crash and the time between the point at which the Fed ceases to increase interest rates and the market bottom. And you'll see the Fed pivot does not mark the bottom of the bear market by a long way.
So actually, that's really interesting, Keith. So if you sort of try and interpolate that on current data, the Fed is still tightening. We have had a 20 to 30% drop in markets already, and we have maybe another 12 to 15 months on average to go before the bottom of the market.
Yes, absolutely, Richard. And the thing is, we get some comments because we have been, frankly, relentlessly bearish that, it's close to bottom. You should be thinking about buying stocks. Well, frankly, no, I don't think we're anywhere close to bottom. And, I'm afraid that over the coming months, we're probably going to be very consistently in cash and not doing very much, because the thing is, these cycles play out over many months, and the greatest skill you can have in these periods is just patience, not going too soon.
I would also say that there is one exception to that thesis, Keith, which I completely agree with, which is if central banks start doing QE again for other reasons.
Okay, well, let's cross that bridge when we come to it.
Yeah.
So, in summary, the world economy is a super tanker that takes a long time to turn around. And the effects of very tight monetary policy continue to affect the economy, even when the banks then turn around and start cutting. And so the peak in the Fed's fund rate does not mark the bottom of the bear market, because tight monetary policy continues to feed through and affect the economy for many months afterwards. So don't buy equities just because the Fed has decided to cease raising rates and start cutting them. Okay, on to good news, and we need it.
Okay, this is in the wrong podcast.
Yes, well, so this, you may remember, is the picture of a starving polar bear, and the narrative attached to the photo was that global warming was causing the ice floes to break up, which meant that polar bears were having difficulty hunting seals and they were all starving. Well, complete nonsense, frankly. Contrary to what you might have been told, polar bear numbers are exploding, and they've massively increased since we labeled them as an endangered species. And this table finishes in 2015. If you go on the internet and look at the latest figures, they had another good year last year. Polar bear numbers are increasing. And what I'd say about all these apocalyptic forecasts of how humanity is, wiping out much of the wildlife on the globe. And you'll notice, by the way, that the Great Barrier Reef is having a very good year and has the highest coral coverage since records began in the 1980s, is that I can't kill the mold in my bathroom. The idea that we can wipe out all the life on this planet is just silly.
Keith, you're using the wrong sort of bleach.
Yes. Okay, on to inflation watch, Richard.
Keith. UK inflation is depressingly high, and with this level of inflation, it's a danger that it becomes entrenched, and that would be really quite unpleasant. Interest rates continue to go up significantly, all the social problems that it would produce. US inflation is high, but not nearly as high as the UK, and it does have this down arrow in September, which we don't have. And the EU inflation, CPI, 9.9%, very similar to the UK, and core a little bit lower, but moving in the wrong direction. Germany, look at that, 10%. And core in August was 3.5%, which just looks out of kilter to me. And then Japan's got this extraordinary low rate of inflation, particularly given that their currency is being totally trashed. And if you look at the interest rates, the UK 2.25, the US 3 to 3.25. Okay, relatively high. I say relatively high because in absolute terms they're not high. The EU and Germany 1.25 with 10% inflation, extraordinary. And Japan, basically, the government is continuing to do QE to try and support the currency, which sounds like an oxymoron, doesn't it? The 12-month changes in CPI for the US. I mean, this is a hard graph to interpret because clearly things have moved down a bit, but it's like one swallow doesn't make a summer, and you need to see a significant drop. And the other thing we have discussed, Keith, from time to time is that inflation comes in waves.
Yes.
So we may have seen the peak of the first wave, but it doesn't mean to say there won't be a second wave or a third wave.
But in the US, we are seeing lots of signs that inflation is peaking. So this is the New York Fed's underlying inflation gauge, and they're all forming a top.
And US core CPI and import prices. So the core services actually hasn't really done terribly much, has it? It's still around about 5%. Core goods has actually dropped dramatically from late 2021, and non-fuel input prices have had a big decline recently, but are now ticking back up. Slightly mixed sort of mixed situation, I would say.
Well, the import prices because the strong dollar
Yeah.
and the dollar continues to strengthen. We'll show you the chart later. What this chart really shows is that core goods um, inflation is falling as we would expect, and as we've talked about in previous weeks, as the supply chain problems of the pandemic basically cease, and the freight indices are all falling back to earth rapidly. But services, that's a reflection of broadening inflation leading to high wage growth. And it is concerning that that is not yet coming down. Of course, services are the majority of the US economy.
This chart shows the difference between core CPI as measured by the Fed and core CPI as measured with the Zillow rental index. And the point being here that if the Fed had actually used a much more realistic measure of accommodation and shelter inflation, they would have been on it faster. But because they use this absurd method of determining what the shelter inflation rate is, they missed the trick
Yeah.
significantly.
You have to think that I hope they'll have a period of reflection after all this is over and realize that their measure of rents is just silly. And
But of course, the problem that they've got, Keith, is that they use this measure of rent because at the time of, with QE and debasement of fiat currency, they didn't want property prices to be affecting the inflation figures, which they would have done had they used the Zillow index. And now they've got caught out by it.
yeah, because what this means going forward is actually real inflation will fall, but their measure of inflation will stay high. So they'll be forced to have higher interest rates than they otherwise would have.
Yeah, thereby damaging the economy both ways.
Yes, precisely.
So the G5 credit impulse says both inflation growth and growth will drop hard, which is not a soft landing. So what this chart is showing is there's significant correlation between CPI, the S&P 500 earnings growth, and the G5 credit impulse. And you can see that G5 credit impulse has massively dropped, and therefore we would expect the other two to follow with it, which means a hard landing.
Yeah, you notice the size of the lags. You're lagging CPI by 5 quarters, i.e., a year and a quarter.
Yeah,
earnings by year.
That ties in with what we're talking about with the Fed's, how long it takes between the Fed stopping tightening.
Yes.
And the recession, the bottom of the recession to hit.
Yeah, and the thing is, we do this podcast every week, but the reality is, these trends play out over quarters, and so be patient.
So the Atlanta Fed's wage growth tracker may have peaked, I would say. I think it's very difficult to tell at what point these things do peak. Clearly, it's ticked down, and which is good news from the point of view of overall inflation levels. But I think it's early to say that we've got there yet. I think the point here is that other things appear to be slowing down as well, and that may well be that this is also going to slow. And food price inflation has definitely come back. So the US food inflation rate in orange and the UN food price index in the dark line. But I would add here that there is a lot of talk around about how food inflation in 2023 may be high. And I noticed that one of Europe's biggest fertilizer manufacturers has slashed production.
Yes.
So I don't think we're out of the woods yet with food price inflation.
Very good point, Richard.
And falling domestic freight prices mean falling goods inflation, which is absolutely true, and that is what's happening. And there's been a huge drop in the price of China to US freight rates, which is good news for US inflation and probably bad news for the Chinese economy. This is an interesting chart. There's quite a tight correlation here, isn't there, between wage growth and JOLTS openings with a lag of 9 months. And that suggests that if JOLTS openings are dropping, which we saw earlier they are, then a wage growth would drop. So there's a number of factors coming together suggesting that at least this peak in inflation is in the past, except of course shelter, which we've just discussed. And this is showing that rents are now falling, which means there will be that will feed through ultimately into all of the inflation indices. So a lot of data there, actually, a lot of different parts in that, but it does suggest overall that US inflation may well have peaked, but that because of the way that the Fed measures housing inflation, which is a huge chunk of the index, that may skew the figures a bit. And do bear in mind that inflation does come in waves, and there may be future waves as well.
Thank you, Richard. Okay, on to Recession Watch. And this is a survey of US CEOs, and their confidence fell yet again last month. And you'll see that actually the CEO confidence survey is an amazingly good predictor of recessions. The vertical gray bars are recessions. So if the past is any guide, CEOs are essentially forecasting a recession. And if we turn to the bond market, well, the 2-year, 10-year spread is now negative. And again, that's a very good forecast for recession. But the best forecaster is the 10-year 3-month. And that has a 100% record. And it's just inverted. It inverted 2 days ago. So the bond market is now definitely forecasting a recession. And if you look at the effect of tightening monetary policy, so mortgage payments in the US have absolutely shot up by the best part of 60% year on year. And as we discussed earlier, that has to slow the housing market. And as we've covered many times, the housing cycle is the business cycle. And to add to recessionary pressures in the housing market, high house prices have caused a big surge in building, and there's going to be a lot of supply coming onto the market, just as we know sales are falling. And this is an update on the Fidelity Business Cycle Tracker, and they have China very much in contraction, and the UK and Eurozone late cycle heading into recession, the US also heading into recession, but not there yet. But the SARM rule, which, reminder, looks at employment, is showing no sign of recession or an imminent recession. Although if you look at historic recessions, you'll see the SARM rule generally tends to pick up when a recession has actually occurred. So reminder, employment is a lagging indicator. Although the economic surprise index has turned positive recently, and you saw that in this week's economic data, which showed surprising resilience in the US economy. Junk bond yields are rising, but nowhere near their levels of actually the great financial crisis, pandemic, or just earlier scares in 2016 or 2012. So bond yields are not particularly elevated, which is surprising given the outlook for US earnings.
And also given the big increase in interest rates. I mean, they have gone up from about 3 to 5, but yes. It's surprising that they haven't reacted more, given that they're much higher risk.
Precisely. But having said all that, the Chicago Fed Financial Conditions Index has tightened considerably. And when we look at the outlook for earnings, well, earnings recessions last many, many months. And we are only 3 months in to the latest one. And previously, you're talking about 18 months or more. So there's a long way to go in this bear market. So in summary, the yield curve is now forecasting a US recession. Reminder, there are lags in everything. So the yield curve turns negative long before a recession. So financial conditions are tightening, and the US jobs market remains strong, but is beginning to fall from its highs. Onto the energy crisis, Richard.
The energy crisis, well, at the moment, we've got a position where there are about 35 LNG tankers queuing to offload their cargoes in Spain and Portugal. So Europe actually has done an excellent job in filling its energy storage, as we discussed, I think, last week. And I'm guessing also that the offtake facilities can only cope with a smaller number of tankers than is actually arriving. And then finally, as we know from our own experience, so far the autumn has been very mild, and so gas demand for heating, and either via electricity generation or directly via heating, would have reduced. So gas prices are falling, and there seems to be a bit of a supply glut at the moment, which is not what we were expecting, to be honest. It remains to be seen what happens with the weather during the winter time, of course. And there's very little, so the European storage withdrawals are pretty much at close to their all-time lows, again suggesting that energy demand, gas demand, is relatively low, and that would be because two factors, presumably. One, we know that gas prices have forced industrial production down, and that would have reduced consumption demand, and the mild weather. So this chart shows the gas draw in orange, and the shadowy area is, we think, the average draw over the previous 25 years. And you can see that the draw has actually been and remains relatively low to the average.
This shows EU and UK LNG imports, and the red line, dark red line, is 2022. And the point is that they're stable, they're not growing, because essentially we're maxed out. All the existing infrastructure is running at full capacity, and so we can't grow it any further.
And we've seen the EU gas prices continue to fall over the past few weeks, and they're now almost down about 60% from the peak in late summer. Still significantly higher than they were at this time a year ago, but nevertheless falling substantially. And German electricity prices have fallen concomitantly as gas is used to generate a lot of their electricity. But the markets don't necessarily believe that this is going to persist. So the 23 contract price has stopped falling. And that's because the markets presumably are concerned there might be a cold winter, which will boost demand and will demonstrate the bottleneck in supply that still exists if there's high demand. EU gas storage at 92.4%, which is a very happy place to be. So I didn't know this. Road hauliers are running out of AdBlue, which is an additive that you have to add to diesel engines. I don't quite know why, because I don't have a diesel.
It reduces NOx emissions.
Ah, right. You put it in the fuel tank?
Yes. There's a separate tank you put it in. Essentially, it's urea. And urea reacts with nitrous oxides, essentially. Right. Neutralizes them.
So presumably they're not allowed to run if their NOx emissions are above a certain level.
Yeah.
That's problematic, isn't it?
Well, the thing is, it's one of those things that if things got really bad and they ran out of AdBlue, Germany would face the question of whether allowing the whole country to grind to a halt or allowing NOx emissions to rise.
Which would they choose, I wonder?
Well, given their track record with, let's say, nuclear, they might choose to close down the entire country, you know?
You never know. So the Eurozone has swung very, very quickly from a trade surplus to a huge trade deficit. And that's quite extraordinary graph, isn't it? And it's the energy balance, energy that has done it. But not good for EU finances. And Japan, to say, well, Japan is restarting 17 nuclear reactors and extending the life where it's safe to do so. So Japan is going full nuclear again, which, of course, it should never come off as nuclear, but it's going right. And frankly, the only way to supply the world's energy needs, if you're going to stop using fossil fuels, is by nuclear power.
Yeah.
And I don't speak German, but I'm reliably informed that the top line says German household gas consumption is down 26% on the 2018 to 2021 average, presumably because we've had both a warm autumn and people are being careful.
Yeah, I think people are delaying putting their central heating on, and this is very encouraging.
As are we. I don't know whether you are, Keith, but we haven't had our central heating on yet.
No, absolutely. And I noticed both of us are wearing jumpers.
I'm wearing two.
There you go.
Sorry.
Yeah. If you're watching this out there, please donate to the channel so Richard can turn his central heating on.
It's cold. So scientists are forecasting that European temperatures will be above average this winter, particularly for the UK and the Atlantic coast. But I would certainly say it feels to me as if they've been above average so far this autumn. I'm not quite sure what the basis of their forecast is, whether it's the ocean currents or something.
Not sure, Richard. It's akin to magic to me, but it seems to work.
So the European energy crisis, well, I would say it began badly, but it seems to be getting a little bit better as we speak, and warm weather and ample energy supply has resulted in falling prices, which is obviously very, very good news. Long-range weather forecast projecting a warmer than average winter, so we may get lucky. And we do still have an energy crisis, and we're not out of the woods yet. We're very dependent on LNG supplies and the weather.
Okay, thank you, Richard. Now,
Keith is now going to talk about his favourite subject, reflexivity and UK political crisis.
Yes, thank you. Well, I think what's happened in the UK has been absolutely extraordinary. Now, reminder, reflexivity, which is a term I think George Soros coined, is how market participants interact with the market, which then reacts and then feeds back into market participants. So it's the feedback loop between investors and the market. And what's really interesting about the UK political crisis is essentially it's been caused by the markets. So the mini budget caused a big sell-off in sterling and gilts. And the sell-off in sterling really bothered nobody. So last week I was at a lecture with Mervyn King, the former Bank of England governor, and he was saying he welcomed the fall in sterling. But what caused the crisis was the sell-off in gilts, which caused a big increase in UK mortgage rates and led to a lot of concern from UK home buyers and mortgage holders that their costs, their interest costs were going to increase very substantially. And that caused the political crisis here. And so when you have countries like the UK with very high debt levels, and the UK government debt to GDP is 84.5%, essentially we're beholden to the bond market. If the bond market loses confidence in UK fiscal sustainability, then the debt is by definition unsustainable. And so what's really interesting about the UK political crisis is it shows that governments with high levels of debt are now beholden to the bond markets and have to retain the confidence of the markets. So I thought what's happened in the UK over the past few weeks is a really good illustration of reflexivity and how the government's interactions with the bond market essentially caused a change in the government. And it's something that I had not forecast. I had forecast that Liz Truss would carry out her pledges to institute this unorthodox fiscal policy, and that would be a disaster. What I'd failed to anticipate was that that disaster would then feed back and cause a change in government. Richard,
I think I'm mindful, Keith, of a conversation I had with a mutual friend who is a pension fund manager and with a lot of great deal of experience, who expressed the concern about 18 months ago that the UK was hugely vulnerable to a buyer's strike in the gilt market, and that everything would be fine unless there was a buyer's strike, and that was what he really feared. And it very nearly came to pass.
Yes. Okay, on to office rents, Richard.
So we have a chart of total square footage of leases signed annually in the US. And you can see basically pre-COVID, it was around about 250 million square feet. And it has now fallen to about 60 million square feet. And the total square footage of leases signed annually in non-major markets, as opposed to major markets, has done exactly the same thing, but from a higher level. So what this means basically is that commercial property is no longer wanted to anything like the extent that it was wanted post-COVID. And the commercial property office market is in real trouble. So let's have a look at the next chart, which shows a real estate investment trust, which specializes in commercial offices. And you will see that it peaked in 2020 at about 1,300. We then had COVID. It bounced back from that to 1,000, and it's now down at around about 400. So it has lost about 70% from its peak. And I would suggest that it's got quite a long way further to go. The problem with these businesses also is that they can't exit. How do they sell an office for which there is no demand in a falling market? And I know that some of these companies have started to gate their investors simply because although they are notionally a liquid investment, you can buy and sell them on the stock market just like that. When they can't sell their underlying asset, they are a hugely illiquid investment. So yeah, avoid all office space investments. I would suggest it's going to take years for this to work through. And I would also suggest, I think we referred to earlier, that you've got to be very careful about builders for whom most of their income has come from building commercial property, office space. Not warehouses, actually, but office space.
Yes, well, I think even the warehouse market is now peaking because there's been a hell of a lot of investment going into warehouses. And before we move on, actually, can we just thank Wayne J and Lee Bod from our Discord channel for sending us those charts. Okay, and on to the UK labour market. Now, there's something wrong with the UK labour market. So this shows the trend in people aged 15 to 64 who are neither employed nor seeking work over the last decade in various countries. And you'll see in most countries, take Germany, pandemic caused a big spike in people who are not working, but that has now unwound and the labour market has continued its earlier trend. And you can see that the vast majority of countries show a similar pattern. But if you look at the UK, That's not the case. We have not recovered from the pandemic. And so the number of people who have left the labor force has risen substantially and shows no sign of coming down. And that is causing a tight labor market in the UK. So what's going on? Now, if we look at the reasons that 500,000 Britons have left the labor force, then it's not good. It's essentially long-term illness, either physical illness or mental health. So this chart breaks it down. So the bottom dark red area is chronic back pain. Then have heart disease. We then have mental health, other long-term health issues. So it seems that chronic ill health is causing a lot of people to leave the labour force and tightening the UK labour market. And this chart further illustrates that problem. And you see that the far right graphs show that many people are suffering from multiple illnesses. And it is no coincidence that the NHS is now overwhelmed and failing. And so we have 7 million people on the NHS waiting list, and over 700,000 of those have waited over a year for a routine operation. So the failing NHS is now causing chronic ill health in the UK population, leading to a lot of people having left the labour force and a tight labour market. So not good, really. We have failed to invest in the NHS for a long time, and it is now coming back to bite us. And we have left the EU and have explicitly ruled out importing cheap labour from Eastern Europe to solve our issues.
I'd just like to add, that's a very interesting case. I'd just like to add something. I have some, without going into details, I have some personal insight into some of the issues in the NHS. And I fundamentally believe that the management of the NHS, both political and managerially, is very, very weak. It's politically weak because politicians will not stand up and give clear guidance as to what needs to be done to ensure it can operate efficiently. And managerially, I don't think it employs the caliber of staff it should employ, and I don't think it trains them appropriately. And I fundamentally think that throwing more money at it isn't the problem unless you throw money at solving those two issues. And one of them is a political issue. You need competent politicians in place, which we don't have.
I agree that the NHS is dysfunctional. And I mean, I also have a family linked to the NHS, and I know that the IT department is terrible and actually overpays its staff by about a third compared to the private sector.
But so, doesn't get the return that it should get from those payments.
Yes, absolutely. So the NHS does need reform, but we need to fix it, because not fixing it is leading to severe problems for the whole economy.
Totally agree, Keith. I totally agree. But the fix has to be a proper fix, as in addressing the really serious underlying managerial and process issues, not just putting money into it willy-nilly in the vain hope that putting more money in it will somehow do something, because that's what we've done and it's not working.
Yeah, completely agree. Okay, on to the UK consumer, Richard.
Okay, so now going to move on, take a little look at the UK consumer, who, as we know, is under pressure at the moment. So this is the Asda income tracker, and it looks at, so its total household income is £905 a week. Subtract essential spending of £544 per week, less taxes, £149, gives the average family spending power of £211 per week. And this is down £32 or 13% a week year on year in August. So 13% reduction in spending power in a year. And this pretty much coincides with the rate of inflation that we're experiencing, although it is in fact higher, which suggests either the inflation numbers are wrong or that the ASDA family tracker tracks people who have a spending pattern that does not conform with the way inflation is measured.
Well, actually, Richard, we'll go into this further in the coming charts, but the point is that inflation has been concentrated in non-discretionary items, and that has squeezed the discretionary budget. And we talked about this earlier in the year, and we forecast exactly this, actually.
Exactly, yeah. So, year-on-year change in the ASDA income tracker, you can see actually there's been some very healthy years and not very many negative years. And the COVID period was a very healthy period, thanks, I suspect, to government largesse, aka Rishi Sunak, some of whose policies. Anyway, but the deterioration in income, year-on-year deterioration in income over the last 10, 12 months has been very, very severe. Okay, it stopped deteriorating thanks to government's energy subsidy scheme, which is actually in question. The inflation has been highest in the non-discretionary sectors, so things people have to buy: housing, utilities, transport, energy, and food, which has, of course, hit the poorest families hardest. And so we see that the poorest members of society are finding it hard. So the highest income quintile, 5.4% better off. The lowest income quintile, minus 1.2%, down 1.2%. And so there's a skew which is very bad for society in terms of wealth distribution.
Yeah, I found this chart very frightening. I had not realized that the lowest 20% of the population lives on less than £200 a week. I mean, and it's falling. This is not discretionary spending, this chart. It's actually the gross weekly income. So even in an inflationary environment, their gross weekly income has fallen.
So the average weekly discretionary income by household, so the lowest income quintiles discretionary spending is down by £60 per week. And in fact, you could pretty much take the lowest 40% and say they are either down or it hasn't changed. And the poorest quintile suffers hugely. And the highest quintile has done fantastically well.
Yeah. The lowest quintile can't make ends meet to the tune of £60 a week or £3,000 a year. So there's real poverty now at the bottom end, according to the ASDA income tracker. And this chart just reiterates the point and breaks the UK income distribution into 5% bands. So you'll see that essentially everyone is going to have a difficult year with lower real earnings, but the poorest members of society will suffer a huge drop in real income, down 16%. So once again, the poorest members of society get hit worse by the current cost of living crisis.
Oh, wow. This is excellent news for Liz Truss. After just 45 days in office, she's eligible to collect £115,000 allowance for the rest of her life. And I think that's probably what the Conservative MP's plan is. They're each going to take turns to be in power for a week, and they'll all walk off with £115,000 a year. So corrupted have they all become.
Yeah, we need to join the queue, Richard.
So, I mean, we face the UK. So, of course, the lower two quintiles, which we've just been talking about, classically, they are where we're seeing strike action. What we're not seeing actually at the moment is strike action in the NHS, and that actually employs a lot of low-paid people. So we face a winter of discontent. The poorest members of society do face a winter of real poverty, and it's a recipe for political and social unrest, not a happy place.
Thank you, Richard. And on to UK indebtedness, because I should say that all those charts Richard just covered are from August, and they don't include the impact of the latest mortgage rate rises, which will particularly affect the middle income quintiles. So let's now talk about the effect of rising interest rates on UK indebtedness. Now, this is the UK base rate over time. And you'll see at the start of this year, it seems a long time ago now, UK base rates were 0.25%, and they're now 2.25%. So they've risen very quickly, and they're due to rise again next month sharply. But the UK has very high debt levels. December 2021, UK private non-financial debts were 158% of GDP. Reminder, the base rate then was 0.25%. So it was very cheap to service those debts. And if we break those figures down further, so total non-financial sector debt was 289.2% of GDP. Private non-financial sector debt was 158, leaving 130% for general government, all of which was being financed at low interest rates. And you'll see that since we had inflation targeting and inflation came under control and the volatility of inflation fell, and so the volatility of interest rates fell, so people will be more comfortable taking on more and more debt.
So one of the things I think it's important for people to recognize is that debt is pulling future activity into the present. And that works well, actually. And when debt markets first came into being, I think it triggered a significant boost over the decades to economic growth. When you get too far into this situation, as I believe we now have, you get to a point where you have to pay a significant amount of that pulled forward economic activity back. And if, let's say, you've pulled forward 50% of GDP too much, and you pay that back over 5 years, then your reduction in GDP due to basically the repaying of debt is 10% per annum. It's huge. The danger is that we are now in that position. As interest rates go up, people can't afford the debt, GDP plummets to repay back what has been borrowed from the future.
Yes. And on that note, Richard, so this is the UK mortgage rate as reported by the British Bankers Association. And you'll see that throughout the last decade, we've had interest rates that oscillated between 3.8% during the pandemic to highs of about 4.8%. According to the BBC, as of this morning, the latest 2-year rate is 6.65%. That's up here. The 5-year rate is 6.5%. So we have had a huge increase in borrowing costs. And that is going to feed through to a big increase in mortgage holders' interest payments. And so in London, the FT estimates that annual mortgage costs will increase by £8,000 in the coming year. So mortgage holders face, in addition to their other rising costs, a massive increase in their mortgage bill. And in the UK, unlike in the US, everyone is either on a variable rate or a 2 to 5 year fixed. And this shows the number of households needing to refinance. And so every quarter, we're going to have a lot of households having to refinance their existing mortgages at the higher rate. And so over the coming quarters, we'll see a further cost of living crisis.
Yeah, it will sort of surreptitiously worm its way in, won't it?
Yeah. And unfortunately, interest rates are forecast to remain high. So this will be an ongoing problem. And it's been caused in part by the incompetence of the Truss government. Now, if we go through some numbers, so in Q1 2022, total non-financial sector debt was £3.6 trillion. Households had 2 trillion, corporations 1.6, and UK GDP is around 2.3 trillion. So Fitch are forecasting the UK base rates will reach 5% by Q2 2023. And if we model the increase in debt servicing costs by the increase in interest rates, you get to big numbers.
And the danger of all of this thing is there are rapid changes, so there's no time to adapt.
Yeah. So if we look at a 2% increase in interest costs, which seems kind of low actually, then the UK will end up spending 3% of GDP on interest payments, more than it would otherwise have done. And that, as Richard was saying earlier, will have a big impact on the economy. So in conclusion, the rapid rise in UK interest rates is going to cause distress to highly indebted UK borrowers, both households and corporates, because it will divert money away from consumption to interest payments, reducing economic activity. And that will stressed borrowers will not be able to repay some of their loans, which will cause stress to the financial sector. So all that, frankly, is ahead of us, I think.
Agreed.
Now, the investment implications, well, this is only going to add further to recessionary pressures in the UK. Avoid highly indebted UK companies. Avoid consumer-facing UK businesses of any kind. Essentially, people don't have the discretionary spending power that they used to have, and they're not going to be visiting the pub or restaurants as much as they did. And avoid home builders, building supply companies, estate agents, etc. High interest rates, mortgage payments are going to cause a big slowdown in the housing market. But a deep recession will improve the UK's balance of trade and reduce inflation. So in time, the UK will bottom and both sterling and gilts will become attractive again.
I would also like to just add, I don't know what the exact numbers are for Europe, but I suspect they are very much the same boat.
Yes.
In terms of the level of borrowing that has been done at ultra low interest rates. Although they haven't had the interest rate shock that we've had over the last few weeks.
Well, you say that, Richard. I'll show you something in a bit. Now, I'm afraid we're going to have to delay the segment on France yet again because so much has been going on, but I promise we will get round to it. On to other charts. Richard.
Thanks, Keith. So over the past 43 years, US real median wages have risen by 6.9%, which is not very much, is it, for for a real wage increase of 7% in a period where there is supposed to be a rapid increase in wealth, and that's not very much at all.
So essentially, over the last 40 years, we know that GDP's risen a lot, but all those gains have gone to capital and not labor.
Not labor, yeah. Which suggests that labor prices may continue to rise.
Yes.
And normalize the situation. US labor productivity has fallen dramatically since the pandemic. We don't know why, but it's maybe due to working from home, which may be less productive. But whichever way it is, it's not good for the economy. UK has a similar problem.
Yeah.
And Chinese flight numbers, which is the solid blue line, are falling again. And I guess that's twofold. One is they continue to have these COVID lockdowns, and secondly, we don't think the economy is at all healthy.
Yeah. So this is a very good proxy for real-time Chinese economic data. And Chinese economy ain't doing well.
I also suspect there may be an element of the West doing less business with China. And Chinese junk bond prices are still falling. Bear in mind, prices in the inverse of the interest rate, which means junk bonds interest rates are going up. In fact, they've doubled, pretty much almost doubled since January 2021. And it looks like if they go below 55, they're going to continue to fall further. Yeah, so this is low interest rates. And basically what this is saying is we've had a financial asset bubble, and it's been caused by ultra low interest rates. And when interest rates rise, the value of financial assets will fall. And so the wealth is illusory unless you can exit your current financial asset, which will fall as interest rates go up, and buy some other asset which will not fall as interest rates go up.
Precisely, Richard. I think you need to be nimble and play the cycle now.
Yeah. So looking now, weekly checklist on equity markets. So the FTSE All Share unchanged on the week. The stocks Europe up slightly. The S&P 500 down 2.5%, significant amount. Nasdaq nearly unchanged. Hang Seng down 2.7%. Topics not very much to change. Bitcoin down 3.5%, but bouncing around 20,000 mark. Pound down a bit. It's sort of been between 110 and 113 for a while now. And the euro US dollar also fairly stable. The US dollar index hasn't moved very much in the last few weeks. But I think the right-hand column is the one to look at, isn't it? Where we have some very big changes going on this year, and the dollar index up by 20%. And so there's the S&P. My view is that it's sort of bouncing around that low, that June low, and that it is now going to drop significantly further over the next few weeks. That's my prediction. And the dollar index is actually really showing no signs of topping out, and I suspect it's going to continue to rise. Graph of corporate profit, S&P 500 versus corporate profits. So we have corporate profits in orange and the S&P 500 in blue, and clearly there has been a total dissociation, which means that the S&P 500 to return to normality will drop to around about 2,500. If it overshoots, it'll drop to 2,000 probably, and that's a 50% fall from where we are. Be careful.
Yeah.
August saw a record number of negative earnings pre-announcements for US companies, which we have been predicting on here for some time now. So we're starting to see that earnings are falling as against estimates. And that then is the earnings recession, which combined with an increase in interest rates results in a fall in the market. Market liquidity. Now, I don't actually know how they measure market liquidity, but what it really means is that there's a danger of you getting stuck with things you don't want to be stuck in. Or you can only get out of them with a very big bid-offer spread. And that is quite dangerous if you are sitting thinking that you're going to, if things get bad, you're going to liquidate an asset, and then you find you can't. And I think, Keith, you had a salutary lesson that you tell from time to time, don't you, about how you got stuck in that trap.
Yeah.
During COVID, wasn't it?
Well, I had this small position in US Treasuries, US Treasury bond ETF, and the US Treasury
the most liquid market in the world.
Yeah, and I just couldn't get out. But going back to liquidity, Richard, how you measure it is just about the depth of the bids and offers in the system, and there's just not much liquidity out there. And the danger then is, as you say, you just get trapped, or it costs you a lot of money to exit your positions.
So that's a warning sign. And long-term charts of tech. It has. I don't think you've got enough O's in that long piece. It has further to fall than that, surely. I mean, if you take a really pessimistic view, and let's say the really pessimistic view is 0.2, it's got 90% further to go. The ARC Technology Fund is versus the Nasdaq. It's I mean, yeah, that's draw your own conclusions, don't you?
Yeah, it's down. ARC is down 78% from its peak, but do you remember the Neu market in Germany, which during .com it had all the Germans' dodgy internet companies, and it's fell 95%. The whole market. So a lot of companies went bust, but the whole index fell 95%.
I wonder what would have happened if you'd invested in the index at that point. Just out of curiosity, had you got your time?
I'll look into that for next week. I don't think it exists any. I'm not sure whether it exists.
It probably doesn't. You'd probably have to sort of recreate it with the components that exist. And the average duration of a bear market is 446 days, which is 18 months. And we've had only a few days here.
Yeah.
So we've got, in terms of average duration, we've got a long way to go. The market has been suckered by QE, basically, into thinking that 20% and it's over.
Yeah.
As long as QE doesn't start again, or we have QT, the market will continue to fall.
That's a very good summary, Richard. I completely agree with you.
And low PE stocks massively outperformed high PE stocks in the inflationary 1970s. And that is basically a lesson for where we are now. I think that where you really want to be is in low PE stocks that aren't also exposed to consumer discretionary expenditure.
Yeah. Energy, not tech.
Pick your low PE stock. The fear greed index. We're quite a long way into fear at the moment, aren't we? We haven't had extreme fear yet, though, have we?
Well, a few weeks ago, it was right down extreme fear, but it's recovered a bit, actually.
Of course, what this can do is can flip flop quite quickly, can't it? A bear market bounce, and you get into greed, presumably.
Yeah, that's true.
And we still have investors not. I mean, look at the right hand scale. We still have investors not really cutting their equity exposure, moving into cash. And if and when that happens, that will force the markets down. And US retail traders sold $2.8 billion worth of stock last week, which is interesting.
Yeah. So previous chart shows that they're overweight and, they were still buying, basically. But
can we get this chart sort of updated fairly regularly, do you think, Keith?
Well, I get it from the Marketeer when they decide to cover it. If anyone out there has a regular source, please can they let us know, and we'll try and include it on a regular basis.
That is quite interesting.
Okay, thank you, Richard. On to commodities and energy commodities, and Brent and WTI oil prices both drifted off this week. So we had a big spike last week because of the OPEC Plus announcement, and that is unwinding. So once again, fears of demand recession dominate. Now, in Europe, we've had big falls in natural gas prices, as we discussed earlier. Coal drifted off by 1.3% on the week, still up 131% on the year. And uranium had quite a large bounce, up 5% on the week, 20% on the year. Okay, data specific to the oil market. Well, US is still seeing consistent inventory drawdowns. So the oil price is drifting off, but the inventory data depict a US market that is undersupplied in crude. And the US can't continue releasing from the SPR forever. What's going to happen when they stop?
Yeah, and I think the thought is that they will stop after the midterms, isn't it? And I read
Yeah.
today that I think Goldman is predicting a 30% surge in the price of crude after the midterms.
Watch
Now,
this
I wouldn't
space.
necessarily trade on the basis of what Goldman Sachs says, but it's interesting that they've come out with that.
Yeah. US total crude production recovered by 100,000 barrels last week to 12 million. Reminder, it started the year at 11.8. And US shell's meant to be the world's swing producer. Well, it ain't swinging. And
No.
Baker Hughes rig count recovered by 8 to 610. So this is crude. It's had a little spike on the OPEC Plus announcement, but is drifting off. Although the oil price is coming off, we still have a structural problem with diesel. You remember that over the past decade, the US has net closed refineries, and we're getting a lot of diesel from Russia, which is now subject to sanctions. And so you look at this chart, and it shows US refinery production of distillate fuel oil, and essentially it hasn't grown in 7 years. And it's down from its peak of a few years ago. And Chinese production of diesel has also fallen. So we are structurally undersupplied in diesel. Inventories are falling. And the world runs on diesel, and the crack spread is very elevated. And to verify this, just go down to your local petrol station. The spread between diesel and petrol is enormous. And the EIA is forecasting that we're going to see a tight market next year, which is good for oil prices. So right now in Q3 2022, which has just ended, they're saying there's a positive balance over the last quarter, which had led to falls in oil prices, but the market will now tighten. But contradicting that, in the last couple of weeks, you've seen global onshore inventories rise by a counter-seasonal 30 million barrels last week. So is the world economy already slowing? Are fears over demand destruction real? And therefore, the oil price will continue to fall, and previous forecasts of a tight market will be wrong. So, reminder, I'm really torn on the direction of oil prices. I've got no idea. It's a question of how much demand destruction will there be from a slowing world economy. I think we just have to wait and see. It's too uncertain now to make a call. Historically, whenever there's been a recession, there has been a sharp drop in the oil price. So post 2008, the red line is the oil price. The dotted line is US energy prices, CPI. In both the pandemic and the GFC, in fact, in all recessions, you get lower oil prices due to lower demand. Okay, on to gas futures. Well, we've covered this previously, but Dutch natural gas futures have fallen very sharply, although bounced in the last day. UK has a similar pattern. US natural gas futures are also coming off sharply. Coal kind of flattish at a permanently high plateau. Uranium had a good week, up 5%. Industrial commodities, Richard.
Thanks, Keith. So aluminium down 7%, and I noticed that the LME stocks of aluminium have risen dramatically in the recent weeks, which is sort of slightly counterintuitive given that we've had shutdowns of production in Europe, and the issues with Russia. And I think that there's clearly an element of demand destruction in that, I would guess. But I think that's why the price has dropped. Cobalt unchanged, copper down 2.3%. As we discussed last week, copper very vulnerable to a Chinese slowdown. and we're certain there is a significant Chinese slowdown. Chromium up 1.5%. Iron ore, like copper, vulnerable to China, down 2.6%. Lithium up 3.8%. The desperate need for lithium for battery metals is still ongoing. And I noticed that I think Toyota is thinking of leasing its vehicles so that it will retain ownership at the end, so it can then recycle the battery materials. Neodymium 1% change in the week. Nickel down 1%. Tin down 2.5%, halved this year. Big change for tin. Vanadium unchanged, and zinc up 2.2%. Just note that nickel, although it has that enormous spike, which caused all sorts of eruptions, it's actually only 6% up on the year. So it's aluminium, cobalt, copper, chromium, iron ore.
That, it looks like a bad chart. That's steadily drifting off.
Yeah. Lithium looks like it might be getting ready for another run up, actually. Neodymium, nickel, fairly flat for quite a long time now. Tin still running down. Vanadium and zinc. So on to precious metals. Gold and silver didn't have good weeks, both down around about 2.5%. Platinum up 0.7%. Rhodium down up, I beg your pardon. Rhodium up 3%. And palladium down 7%. I don't know why those big moves in rhodium and palladium. So there we have gold. Although, of course, in non-US currencies, gold is actually performing quite well. Silver, platinum, rhodium, and palladium.
Okay, thank you, Richard. On to rates. And we have had a dramatic few weeks in the market. So at the end of this week, the UK gilts market has stabilized. So we've seen small rises at the short end and substantial falls at the long end. So the 50-year was down 43 basis points on the week to 3.5%. But what's very interesting is if we now turn to the periphery of Europe, their 10-year rates have continued to rise during the week. So we're seeing globally continually rising government bond yields. So in Greece, the 10-year rose by 20 basis points in the week and is now above 5%. Italian bond yields rose 9 basis points on the week, now at 4.76%. Now, one of the side effects of rising bond yields is actually pension funds are now in surplus, which is great. And so this is the number of UK pension schemes in deficit. And you see they've pretty much disappeared. Almost all the pension funds are now in surplus. And so that is one good side effect of rising rates. And rising rates are also very good for retirees and savers. But if we think back to our earlier segment on the UK income distribution, rising rates are good for people with existing wealth because their income is now going to increase. The poorest members of society will not benefit from this. Now, good news again for the UK is that the new Chancellor has imposed fiscal discipline and the market is no longer expecting the Bank of England to have to raise interest rates much higher than in the US in order to get inflation under control and reassure the markets. So that's good news. So what I find very odd currently is the market is pricing in lower inflation next year, but bonds are continuing to sell off. You see here, there's a big divergence between bond yields and PMIs. Normally, falling PMIs lead to falling bond yields. That is not happening. And that has caused me personally to lose quite a lot of money. And we will go into that in a minute. And returning to Italy, foreigners have been dumping Italian bonds. Now, the new Italian government is talking about increased fiscal largesse to compensate Italian consumers and businesses for the energy crisis. How are they going to fund that? And bond market liquidity is very poor, although foreigners have been buying US long-term treasuries, which is against my expectations. And why then are treasuries falling? Somebody is selling them. So we look at the UK 10-year. Now, look at the absolute levels. So the UK 10-year at its worst yielded 4.5%. And earlier in the year, it was below 1%. And that rise of 3.5% feeds through to big increases in mortgage rates and distress in the UK, and essentially led to a political crisis here. This is the 30-year. You see it's come down quite well over the past week. This is the US 10-year. Now, bear in mind, yields of 4.5% caused a political crisis in the UK. US 10-year yields are trending relentlessly higher. This is German Bund yield, 2.4%. Look at Italy. Like the UK, it started the year at yields of less than 1%. The yields are now 4.8%, i.e. higher than UK yields at the worst of its crisis. And that will feed through to big distress for highly indebted Italian corporations and consumers. Richard.
I should also add there, Keith, that if you look at that chart, it looks very much to me as if that yield is going to break out to the upside.
Yeah. And unlike the UK, Italy doesn't have its own independent central bank. Yeah. So what's the ECB going to do? This is Greek 10-year. Now, reminder, almost all Greek bonds are held by institutions, so this doesn't really matter. If there's a crisis, it will be caused by Italy. Seasonality chart, well, mid-October, most volatile month of the year. And concluding comments, well, dig a trench, grab a tin helmet, because frankly, I think the trends are all accelerating to a climax, particularly in government bonds. I'm very concerned about that. Now, earlier in the week, I recorded a short segment with Stuart Owen describing his portfolio performance for the year, which I will include now.
In contrast to Keith and Richard, my performance has not been quite so stellar. I am now down 8% for the year, and that's measured as at the close of business on Monday. It's changing rapidly at the moment for reasons that I'm just about to go into. One big reason, of course, is that in contrast to Keith and Richard, I have remained more fully invested. For me, it's time in the market. For Keith, it's timing the market. And that has been much the most successful strategy this year. So I'm down 8%. What has been hurting? Well, the big emblematic example is what's happening to real estate investment trusts. Now, I've got a pretty chunky allocation in my SIP to REITs. I've got about 30% in REITs. And the reason I did that is because I liked the CPI link in the revenues of the REITs, and I like the favorable tax treatment of REITs in a SIP. I'm not, I hasten to add, 30% allocated to REITs across all of my portfolio, but I am in my SIP. Now, what's been going on with REITs is, I think, worth a quick think through, because it's affecting many other segments of the market. Now, I've got a little table, or two tables on the right here, which are a little worked example of what's been happening in the REIT market. So, for instance, imagine a REIT that generates £100 worth of rent. It might typically have interest costs of about 16, based on being about 25% geared, and based on the old regime of having very low interest rates of about 2.5%. The REIT might typically have operating costs of about 15, leaving a profit of about 69, which, given that it's a REIT and it has to distribute most of its earnings, that 69 is a very good proxy for the dividend that you're going to get. And so if that is the P&L picture, think also about the asset picture. Now, if you've got a REIT earning £100 of rent, how would you value the property? Now, typically this is done via the net investment yield. Now, that might historically, prior to this year, been as low as, say, 3.5%, even, or 4%. So valuing rents on a 4% yield would give you an asset value of £2,500. That, in a way, is an example of the situation last year. If we roll that forward and we take account of current market environment, then it's rather different. So let's assume inflation of 5%, but that the net investment yield increases to 6%. Now, in this case, the rents have gone up from 100 to 105. The interest cost nicely doesn't move because this REIT has got fixed debt. Some of the REITs out there have actually got debt fixed for over 12 years. Operating costs nudge up a bit, but the profit has now gone from 69 to 74. So via the action of gentle gearing, a 5% increase in rent has led to a 7% increase in the dividend. I should be happy. And that's, in a sense, the picture that I bought into. The trouble, of course, is the asset value. Now I've got 105 of rent, but I'm capitalizing it not at a 4% net investment yield, but at, say, a 6% investment yield. Now the asset value drops from 2,500 to 1,750. So although I'm warming myself with the dividend, which is up 7%, I'm out in the cold with the fact that the asset value has fallen 30%. Now, this is the issue across many segments of the market, where assets are being valued on very low investment yields. And as we've seen, the huge sell-off in gilts, gilts having gone from 3% to 5%, say, and if you want to apply a bit of a risk premium for property beyond the gilt yield, you need to add even just 1% on top of the gilt yield. Now you're at a net investment yield requirement of 6%. So the asset value has to fall heavily, such that that rent will now give you the desired income yield. So basically, many different asset values have been undermined by applying a higher discount rate. Well, that's a stylized example of what's happened to a REIT, but a similar thing has happened to some of my infrastructure investments and some of my green energy investments. So I've been hurting across the board. I'm warming myself, cuddling myself up with those dividends and the dividend increases, and hoping that the change in the economic policies will lead to a reduction in gilt yields and hence a corresponding rise in the asset values of, for instance, my REITs. But that's why I've been hurting this year.
Thanks, Stuart. You're intending to hold these to maturity, are you?
I'm intending to hold them unless the operating performance does poorly.
Right.
Most of the REITs that I own have got RPI or CPI escalators in them. And in most cases also have got long-term fixed rate debt. So I'm hoping that I've got a real asset which is backed by a nominal debt, and that if it's paying me, it used to be a 4% dividend yield, now it can be 6 or 7% dividend yields on these REITs. I'm continuing to harvest that income and to reinvest it. So actually, one question I had for you, Keith, is that I know at some point you want to go heavy on UK gilts and long gilts. To some extent, you could get even further gearing by buying into companies where the asset value will be inflated again if gilt yields come down. It's another possibility compared to just buying a long gilt.
Actually, that's a really good idea, Stuart. And I should be phoning you up and asking you, which ones you recommend. And the thing is, when you look at the interest rates, yields in the US Treasury market and the gilts market, there is a real disconnect developing between falling inflation expectations and rising yields. Now, I'm not sure what's going on. Clearly, I've been early in my gilts and US Treasury trade and have lost money. Now, it may be the unwinding of these LDIs is causing pension funds on both sides of the Atlantic to sell bonds, which is driving yields up. But I just don't think that's sustainable. I think as the economy slows, and if you look at the interest rate impulse, so how quickly central banks are raising interest rates. I mean, they're raising them very quickly, and that works on a very enlarged global debt level. So I think that's going to slow the economy quickly, and that should bring both inflation and bond yields down, in which case, you'd expect the price of your REITs to recover. And I think I will be joining you. I like the sound of 6 and 7% yields. Great.
I will forward you a few examples.
Great.
Keith, just to mention one bit of activity because it's sort of connected to gilts. At the back end of last week, I was just flabbergasted with how much UK index linkers had fallen. An ETF, for instance, that spans all the different maturities of linkers had halved over the year and was now yielding 1.9% real, where historically linkers had been about minus 2% real. And I just thought this was LDI-driven forced sales, a bit like you're talking about. So I actually took a bit of a trading punt and bought some UK linkers. And as at the time of recording, that's working out well. Given all the volatility in markets and politics, anything could go wrong. But for the moment, that's helping me out a bit.
So, Stuart, did you buy the linker or did you buy an ETF? Well,
I should have bought the actual linker because then the capital gains will be tax-free. However, because in this case, my trade was done in an ISA, I wasn't going to pay capital gains tax anyway. And I wanted frankly, the simplicity of the ETF because the market was moving fast. And this at least was liquid and quoted, and I could do it at the touch of a button. So in fact, I did it via an ETF, but the important point outside of a tax wrapper is to buy the actual underlying gilt because then the capital gain is tax-free.
Yes, very good point. Okay, thank you, Stuart.
Thank you, Keith.
And now on to Richard. What have you been up to this week?
Thank you, Keith. So my portfolio changed for the year up 0.7%, so a bit down last week, mostly because of the change in the price of gold, and which is bouncing around a bit. My relative performance is up 11.2, but I'd much rather have a more positive absolute performance in my portfolio. No changes, no purchases, no sales. I have a few charts, things that I'm watching, keeping an eye on. So this is Wisdom Tree Wheat, and you can see that it had that big spike. I do think that agricultural commodities are going to go up next year, 2023. I think this is an interesting chart to watch, actually. But it has pulled back from that big spike that it had and may come back down further. This is the agricultural, which is the agricultural ETF, which actually looks very different to the wheat because obviously it's a broad spectrum of agricultural commodities. It hasn't had that big spike, but again, it looks like it's not showing signs of weakness, that chart, and it looks to me as if it might well break out upwards. So I think that's an interesting one to watch as well. And then we have yellow cake. So we talked about the price of uranium, but what's interesting to me here is that since basically January 2021, December 20, so in 18 months, the price of yellow cake has doubled. And it's on a fairly consistent uptrend. And again, it's not looking weak. Now, yellow cake, if you remember, just buys uranium, holds it. I think that is uranium via the yellow cake chart is looking quite strong. And this is the spot uranium miners ETF, which is in one of these classic wedge formations. And I think if it breaks out here, then I may buy some of this, but I don't own any at the moment. And the last one I wanted to draw attention to was the long-term chart of the Germany 40 index. And you'll note that German interest rates are now 2.5%. If European interest rates go up to 4 to 5%, I would expect the German 40 index to fall substantially. And I think this index also has a long way to fall. It's come down to its long-term trend line, and I think if it drops back below that long-term trend line, it has a long way to fall. And so I just thought those charts were quite interesting to take a look at, Keith.
Okay, thanks, Richard.
And how was your week, Keith?
Thank you, Richard. Well, I had a very busy week. I closed that week up 0.7%, and I'm having a good year. Okay, so we talked earlier about how I had failed to anticipate reflexivity and how the sell-off in the gilts market was causing a complete reversal of UK government policy. Now, on Monday morning, I thought that actually the outlook for the UK had completely changed. I needed to change. So I then had 95% of my assets in US dollars. And I realized two things. First of all, that was too much, and I needed to reduce that. And also, I had been persisting with my bet on US long bonds. It wasn't working, and the bonds were actually accelerating downwards. And I should recognize that I was wrong and close that position with the aim of getting back in. So I sold the entirety, apart from a tiny rump position of my position in the iShares US Treasury 20-year plus ETF. And despite the fall in sterling, that cost me a lot of money, down 8.8%. I also closed half my position in the US Treasury 1 to 3 year ETF, which I use as a US dollar cash proxy. And I'd made a decent return on that thanks to the fall in sterling. I also held 2 US dollar long bonds, closed both of those entirely, crystallizing substantial losses. And remember, a few weeks ago, I opened a small position in the North Sea oil driller i3 Energy, which was drilling the Serenity well in the North Sea. Well, my luck continues to be awful. The well came up dry, no hydrocarbons. I sold it. Now, I bought on Monday morning some UK long bonds to the total of about 5% of the portfolio, in the belief that fiscal discipline was going to return to the UK. There'd been a huge sell-off in gilts, and that may well be the bottom. So I bought the 2071 and the 2050. And this was my portfolio on Wednesday. On Thursday, I actually sold the remainder of my US long bonds, which is now down to less than 1%. So you'll see that having had 95% of my assets in US dollars, I've now moved to having a lot in sterling cash and UK bonds. Now, next week, I will be using that cash to buy a UK money market fund, which I've had a look at a few. I'll make a decision and I'll report back, but you can get at least 3.5%. This is my equity positions, which are unchanged. So I have been caught out by the rise in long-term bonds. And
very good cartoon.
Yes, we showed you some charts earlier where bonds are just behaving very oddly. So actually, this is the 1 to 3 year, which I sold half of and did okay. This is the 20-year plus, and there's an accelerating sell-off, even as inflation expectations in the US come down. What on earth is going on? The bottom line is, I don't know. And it's taken me a long time to make the decision that I was wrong and to just get out and wait and see what happens, because this looks like it's accelerating towards a crisis point.
Mm.
And, you know, frankly, the faster you make decisions and cut your losers, the lower your losses. And I have been too slow to cut my losses on this. Now, this is the 2071 gilt, which I bought in at 50, and it has bounced. And that is one of the reasons I was up this week, frankly. And this is the 2050 gilt. Now, I have started work on a beginner's guide to bonds. And the reason I bought the 2050 is that it has a coupon of 0.625%, which means that you get most of the return by the change in capital value rather than as income. Now, income obviously is taxed at 45% for me, whereas capital gains are free because gilts are CGT exempt. So if you want to maximize your returns from gilts, you want gilts that return most of the money as capital rather than income. Now, these are the bonds I sold, and frankly, I bought them back here in July, and it has taken me a long time to just realize I was wrong, which leads me to talk about decision making. So scientists have actually studied people with damage to the emotional centers of their brain, and they find they can't make any decisions. Now, we think we're entirely rational, but actually, to make any decision, you need to come to an emotional decision. And this week, I came to that emotional decision. Now, the faster you can do that, the faster you cut losses. And there's something odd going on in US long bonds. I just don't know what it is. And so I continue to believe that that is the way to make money out of a recession. When interest rates have peaked, you would expect inflation to fall and then interest rates to fall and long bonds to do well. But I'm now largely out of the market, and I'm just going to wait and see what happens, because rising long bonds have real economic effects. Corporations are all going to have to refinance at massively higher borrowing costs. So something's got to give. Now, talking about stocks, so this is i3 Energy, another dry hole in my portfolio. So I've cut it. Now, a company that we have previously covered on Share Talk, which has had an absolutely torrid week, is Independent Oil and Gas, which you will remember has some gas fields in the southern North Sea. And this week, it cut its guidance on its reserves yet again and cut production forecast by 30 to 50%, which the market feared would actually lead to a liquidity crisis. They have since reassured on that, but you'll see that when you buy these minnows with small fields, the traditional trope is that big fields, big oil and gas fields, tend to get bigger over time. Small fields get smaller. And this is a very good example of that trope. i.e. these small fields in the southern North Sea, which are being developed by independent oil and gas, their production is disappointing. So be warned about investing in small oil companies. Okay, that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.